right? So welcome back, everybody. So we are going to be diving into chapter 11. Now, chapter 9 was all about dealing with cash. Chapter 10 was dealing about, I guess, more in sense of cash, right? What happens when we deal with letting other people, such as our customers, owe us money, right? Receivables. We learned about receivables. We learned about having the option to maybe think about investing in a bank loan or even investing in bank securities, right? And we also got to take a look at what happens usually at the end to keep a really good track record between your bank account and versus your actual accounting using your check or your cash ledger. This time, chapter 11 is going to be completely separate from everything that we learned from chapter 9 and 10. So chapter 11 is going to be dealing with depreciation. Now, chapter 11.1 is going to be looking specifically into units of production. Now, let me first talk about what depreciation is. So, what is depreciation? So, when it comes to understanding depreciation, it basically is a way for us to revalue our fixed assets, okay? So this is only geared towards fixed assets. So anything that's a type of machinery, right? We talked about fixed assets, right? It's either a PP&E, right? It's either a property, plant, or equipment. So anything that's revolving in that, and they have one huge factor. They're tangible, right? A property could be your building, your furniture, any machinery that's inside your building, right? Are all going to be considered a fixed asset. Now, here's the one thing that we need to think about when we make purchases of assets. We need to find some kind of way to kind of reflect when we purchase our fixed assets, how do we use it or exhaust it, expense it, okay? And depreciation is going to be your term here. Hence the word depreciation, right? Just like when we learn how to appreciate, right? It means, or in context, right, appraisal. Appraisal is when we have to go revalue the value of our assets, right? So in this case, depreciation is where we devalue our assets. So that's just, common terminology, but this in accounting, that's how we use it. So instead of adding more value to it, we're going to decrease the value of it. Now, of course, we are bounded by that one rule from accounting, right? Our generally accepted accounting principles. They tell us, no, the minute you purchase your fixed asset, it must reflect that in your book at all times. So what happens is that you're going to create a separate account, because think about it. If you buy an asset, a furniture, a couch, right, and you sit on it, right, over time, we understand that it has to lose value over time, because trust me, anybody, if you try to sell that furniture out, no one's going to want to buy it because it's not brand new. You used it. It's been dented, right? Someone sat in it, right? The pillows are no longer soft because you sat in it, okay? So that's the idea of where depreciation comes from, is that in our sense, it makes sense that when you purchase our assets, the value of it should, in fact, decrease over time. Or other words, things become obsolete. They no longer produce that machine anymore, or they no longer produce that piece of, gadget that in order for your machine to function. Things lose value over time, especially when you use it, okay? Now, of course, for a machine, right, the more you use it, it becomes wear and tear, right? The oils in the machine become, less, it doesn't process as fast anymore. or maybe the springs in there, it's been so overstretched that it no longer can produce exactly what it's been from the beginning that you purchased it when you bought it brand new. So in this case, we need to consider depreciation as part of a contributing factor to what is going to be the value of our fixed asset. This is necessary, right? Once again, I've talked about if you bought a couch, right, and you sat on it, you think you can go around and sell it back to somebody else for a full price? No, because the factor that you sat in it is what loses its depreciation over time. Same thing, a perfect, great example is when you go buy a car for the first time, and the minute you drive off that parking lot, it depreciates in value because two things: you made the machine run. Second thing is you put miles on it. Third, the tires have already been, they've been used. So that is what depreciation is. It's something that comes with buying a fixed asset. Okay? Things lose value over time. Now, of course, what is a good example of a type of fixed asset, right? So we talked about that depreciation is correlated to a fixed asset. And the purpose of depreciation is to spread its cost over time, right? You can't just, the minute you purchase your machine, right? You can't just say, okay, well, I'm going to expense the whole thing over for 1 year. No. So the one thing that is a key contributing factor to a depreciation or a fixed asset is that it has some kind of life to it. Okay? So once again, when we talk about what are examples of it, again, we talked about a car, we talked about furniture, we talked about computers, right? Especially computers, right? Especially because computers have technology that it loses its value over time because newer and greater technology come into play. Now, the only exception to depreciation is going to be land, okay? Now, that doesn't mean it doesn't exist, because I'm going to tell you a little key thing here. You can never depreciate land. However, when you guys pursue, or if you guys do pursue accounting, you're going to learn that, yes, you can depreciate land, but the terminology isn't called depreciation. We deplete the land, okay? Because land can hold a lot of value, right? Especially if you can get natural resources underneath it. So a good purpose of land is that it could be used for natural resources, such as,
I have a good example.
Go ahead.
Back in Pennsylvania, I was going to purchase this land, and the reason why I was going to purchase it is because the mineral rights. There was a gas well on it, and the actual property was supplied by that gas resource. And when it came down to making that purchase, the owner wanted to try to turn around and keep those rights, so I didn't buy the land.
Okay.
But that was one thing that made that land valuable,
Mm-hmm.
was the natural gas well on it.
Exactly. So I was actually going to go through I couldn't specifically know what country it is, but in the Middle East, they're known for their petroleum, right? They're the ones that's pumping up oil or natural petroleum from the ground, and they're mining it, and they're processing it and sending it and shipping it over barrels overseas to us, to wherever that petroleum is needed. So that is exactly why land is considered a value, right? And we don't depreciate it, we deplete it. Okay? So again, if there's a diamond mine, if there's a mineral mine, if there's some kind of natural gas mine on that land, that land will hold value until you get rid of all that natural resources. Then you end up what's called depleting the land, okay? Now, of course, that stuff you don't learn until you're way advanced in accounting, because you're going to learn how to dispose the asset, which is part of the chapter. If you read through it, right, you learn how to dispose or properly dispose a fixed asset. But in this case, I will not talk about it, just because there's so much other stuff that are a little more important. That's if you're interested in it, go ahead and read the rest of the chapter. But as far as that, I just need you guys to know, land can never be depreciated, okay? It can only be depleted, which, you don't learn that in the beginning of accounting. You just always learn that land can never be depreciated, okay? All right. So, once again, depreciation is governed by two essential rules under GAAP. We talked about this briefly, right? We have what's called the historical cost. Now remember, the rule is that you can never recognize the loss or a gain when you acquire the fixed asset in the first place, okay? Whatever you purchase it at that price is going to hold its value until you either get rid of it, sell it, or write it off completely from your company's files. So once again, we always have to recognize, even if we bought the land for $100,000, it's always gonna stay in your books as $100,000 and $100,000 until the day that you sell it. Now, of course, when you write it off your books, it's still gonna hold the value of $100,000, but the day that you sell it, that's where you'll recognize, did you get a gain? Did you get a loss? Okay? And we'll take a look at this when we dive into our fictitious business a couple weeks from now. Okay? Now, once again, another thing is matching principle. Of course, as you depreciate it, you're going to match it upon its original historical cost. So, like I've mentioned before, if you bought a land, if you bought a machine for $10,000, you can only depreciate it up to the $10,000. You can't depreciate over it. You can't depreciate it under it. It has to be exactly $10,000, and that's where the matching principle is going to come into play, where you're matching your expenses, right? Because we talked about expenses. Expenses could be whether you're using the product, spend the product, exhaust the product. So you're going to be matching your expenses to the original cost that you purchased it. So once again, if you purchase a machine for $10,000, you can only depreciate up to $10,000. No more, no less. If you choose to depreciate it less, then you can choose to either write it off as a loss, or et cetera, right? Okay, but you can never go over the $10,000. Right? So let's go ahead and talk about the 5 components that actually are associated with depreciation. Okay? So these are the 5 things that you have to absolutely need. All right? First thing is going to be the cost of the asset. Second is going to be determining the estimated useful life or expected use of production, okay? And we'll talk about that. We'll talk about each core component in the next couple slides, okay? And then we have to talk about figuring out the salvage value, or it's also known as a residual value. So these are interchangeable words, salvage or residual. Right? Basically what it means is at the end of its life, does it hold some kind of value? Okay? You're also going to determine the date of when you placed the asset into service. This is very, very important because it's going to determine when you actually start depreciating it. And the last component that you need to know is, which depreciation method are you using? Okay? So let's go ahead and start with step number 1. Okay? Step number 1 is going to be determining the cost of the asset. Now, when we make purchases of fixed assets, we have to consider that there are many contributing factors that could be included in the total cost of the asset, right? So, inventory is every cost it takes to get the asset to the store, right? Fixed assets are going to be everything it costs you to get the asset ready for service. Okay? Now, that means everything it gets to get the asset to the store, plus any additional costs that you need to take in order to get the asset to be ready to be placed into service. So what are those other things are going to be included? So, for example, right, you're obviously going to start with the selling price. You're going to start with your sales tax, if there is any freight or shipping costs. So that's to get the asset to the store. Now, anything that's going to be included as part of prepping the asset for service will include any installation fees, any training that you need to have for this asset, any fixtures or any maintenance that you need to do before you place into service. So we will take a great look at this in our fictitious business. But for this example here, the extra cost to maintain or to get the asset ready, right, can include if you need to install you need to have labor to install it, right? You need to maybe have it mounted into the ground so then it's ready for service. Maybe you need a little spout for water to go through. All of those are going to be considered fixtures that are going to be applied to the total cost of the asset. So once again, if an installation fee is included, you have to be included into the actual cost of the asset, because the definition for fixed assets is you want to include every single cost that it takes to get the asset ready for service. Okay, so this one's going to include many mumbo jumbos, and this is very, very, very important because you could be tested on this particular criteria. Okay. So any questions here for just the cost of the asset? Okay. So now we're going to be looking at the estimated useful life, and because it's also relevant to including a salvage value. Okay. Now, here there are two contributing factors, okay? One is going to be governed by GAAP itself, and it's also for IRS. For anybody that's a publicly traded company, they must follow these guidelines, okay? And the other one is for sole proprietors, right? They get a little more leniency when it comes to determining all those things. Now, let's talk about what the GAAP/IRS tells us to do. So they say that every single fixed asset has some kind of determined or predetermined useful life. They already have a determining life that it can produce. Okay, so in other words, there's like a little miniature like Blue Kelly book of all fixed assets that are usually already predetermined by just how many people use it, or just how often, if you use it that often. They just determine like a pretty much estimated useful life. So especially with technology, right? Especially like, for example, a laptop. Just because if you use it every once in a while, then it's going to last you for a long time. However, but if you're using it every single day, you can only imagine how long will it last. Okay? So general rule of thumb here is that it usually has a useful life, and the three numbers that you're supposed to remember is 5, 7, and 9 or 11. Okay. Now, of course, 9 and 11 is going to be for buildings. Okay. But because we're just in the very beginning of accounting, I'm only going to have you remember 5 or 7. Okay. Now, typically, most types of like technology or most types of kind of fixed assets such as computers, phones, etc., they usually have a good general estimated useful life of 5 years. So again, a laptop, right? A laptop can last you 5 years if you don't use it every single day. But if you do use it every single day, it might actually be less than that, which is fine. But how the government wants you to act upon these type of assets is 5 years and that's it. No more, no less. It's 5 years. Okay? And then when it comes to the next one, which is 7 years, 7 years are usually determined for furniture or usually for machinery, right? So when we buy furniture, like a desk or something like that, right? Usually, right, we spill things on the desk, right? We put heavy stuff on them. If it's exposed to the sunlight, usually give or take 7 years should be a good amount of useful life that the desk can provide. Okay, same thing with machinery, right? Machinery, anything that produces the product for you, right, typically would have a useful life of 7 years. So once again, these are all predetermined by the IRS. It is a kind of like a Blue Kelly book, right? Now, little did you know, every machine or any type of asset that you purchase, if you look on the box, it will give you the estimated useful life on it. Okay? Some people don't know that. It does say it because now it is a federal law that they must disclose how long this asset should last you. It also gives you like a warranty sticker or whatever, right? That says, oh, usually within the first couple years, if you see that you're having issues with this product, if you have a warranty, we can guarantee to fix it for you. So those are the few things that you need to know as well. So there's technically, you don't have to go find this Blue Kelly book of fixed assets. It's usually determined by 5 or 7 years. Okay. And then of course, with the IRS and Acct, they tell you that at the end of any asset, useful life, at the end of its life, it should hold no residual value. Okay, because in this case, when we're looking at, assets, right, we want to make sure that at the end of its useful life, it doesn't hold any value. Just because the one thing that the government doesn't want you to do is they don't want you to write a gain or write a loss. Okay, so it's kind of a good factor and a bad factor because, of course, if you buy a truck, right, and you're a corporation, and you know for a fact a truck should last you or should hold at least $5,000 value, you can't gain that money. You have to write it off as a complete loss or a complete zero out. So that's one of the rules that you have to understand when you're doing a depreciation, especially when you're a corporation or some kind of organization that isn't a sole proprietor. Okay? But, however, as a small business owner, right, the government gives you a lot more leniencies, especially when it comes to writing off gains and losses. Because, once again, when you are a small business owner, you're more susceptible to having a loss rather than a gain. Just because of how tiny your business is. Your business shouldn't making that much of a profit. Okay? So that is exactly why the government allows sole proprietors to take advantage of establishing an estimated useful life and a salvage value, because for corporations, you're more likely to have to use the asset more than a sole proprietor would. Okay? So, with that idea, therefore, the sole proprietor, right, they can choose to determine their estimated useful life of the asset. So, for example, right, I buy a printer, right? On a corporate level, they could be using that, they could be using the crap out of that printer, right? They could be printing thousands and thousands and thousands of papers. While as a sole proprietor, you might be only using that printer maybe once every week, right? So here, it would suck if you have to determine your estimated useful life based on what other people tell you. So in this case, it's depending on how frequently you use it. So in this case, I could say my printer can last me 10 years. And some printers actually do last that long, okay? Because of how frequently you use it. And of course, as a sole proprietor, if I use it once a week, I can expect that's going to last me for a very, very, very long time. So with that being said, now, you can't just make up any number out of the blue. You can't just be like, okay, I bought a printer, I'm going to say it's going to last me 20 years. You have to go do your research, and you're going to have to actually determine how often you use it and what is an actual value, an actual legitimate possibility of how long that asset can last you. So again, I could say, oh, I never use my printer, so it should last me 10 years. But using extensive research, that's when I can determine, yes, it can go to that capacity because I only use my printer maybe once or twice a week. It's not going to be so detrimental, okay? So that's what the... Go ahead.
I was just going to say, I have an example on that, actually.
Mm-hmm.
In our shop, the printers at the alignment machines,
Mm-hmm.
we used to go through them constantly because even if you keep the door closed, you have weather and dust and everything else.
Mm-hmm.
And so when the one company took over, what we did was we put the estimated full useful life to 6 months. So this way, there was going to be money in the budget for at least 2 printers a year. Even though we usually went through 3, we could at least have 2 in the budget, in case it did actually last the 6 months.
Good.
But we had to change it to that because we were going through them so much, and they only had 1 in the budget with the previous company, per year.
I see. Good. Yeah, so as a small company, right, you have that freedom to be able to adjust your assets accordingly, right? And that's going to be a section where I'm not going to talk to you guys about disposing your assets or revaluating your assets. That's a whole another can of worms that is meant for more advanced level of accounting. But yes, that's a good example. So yes, as a sole proprietor, you do have leniency to determine however the asset's going to last you for. Okay? Not only that, you also get the opportunity to determine a salvage value. Because once again, if you bought a truck and you only use it maybe 3 times out of the week, right? You cannot expect by the end of 7 years it's going to completely depreciate in value. A $36,000 truck could last you anywhere from 10 to 15 to 20 years, as long as you keep it in good maintenance. Now, of course, with that idea, right, as a sole proprietor, because you're not using it as frequent, you can determine a salvage value. You could say, okay, at the end of 7 years, it should hold at least a value of $5,000, because that is exactly why the difference between the IRS and the sole proprietor, or I'm sorry, bigger companies, is because they're more likely to be using that truck. They might be using that truck for every single day of the week, and they might do long drives. Whereas a small company, right, you might be doing short distances, and therefore you have, you have the leniency to go ahead and establish a perfect price point. Now, of course, you can't just say, I bought a $36,000 truck, and after I used it for 7 years, it still should hold at least $15,000. No, 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 no. Same thing here too. The rules of research, Blue Kelly book, all that is going to come into play. So you can't just determine a salvage value just because you said, "Oh, I can." No, it has to be based off of your research and et cetera, et cetera. So once again, some of these things are predetermined, right? Or some people actually do the work for you, such as writing the information on the box, right? It tells you when you buy a printer, it should tell you it can run at least 200,000 sheets, okay? Or whatever. It can print up to 2 million pages, right? So that right there is already a determining factor of how much life it can work. Same thing with a truck, right? They usually tell you, this truck can last you about maybe 150,000 miles before it needs maintenance. That's going to be considered a life, all right? And then again, salvage value, right? A truck, right, shouldn't be depreciated all the way to zero just because you don't use it very often. You can create that determining factor, okay? So that's the difference between the two. Now, can the sole proprietor be lazy and just go with whatever that the gap says? Absolutely. They can use the already predetermined number so then they don't have to do the research. Absolutely. Sole proprietors can follow whatever gap and IRS says that it should be for. However, corporations, anything that's a big business, cannot do what a sole proprietor can do. Only the sole proprietors have these leniencies, okay? So that's very important that you know that, because depending on what company you are, you may or may not be able to do these contributing factors. So because we're in this class and we're learning to be a small business or even being a business owner ourselves, we get to determine the estimated useful life and the salvage value of any fixed asset, okay? So there's 2 more contributing factors right there, right? Any questions in regards to this? Okay. So then the next component is going to be the date of when the asset is placed into service. So as we mentioned before, right, the most important thing that we need to do is to make sure that the cost of the asset is going to be including everything to get the asset ready for service. In this case, the day that we place it into service is very important because it will determine whether we depreciate for this month or not. So the general rule of thumb here is that if it is within the 1st and the 15th of the month, therefore you should depreciate that month. If it falls any day between the 16th and either the 30th or 31st of the month, you're going to depreciate it the next or the following month. Now, it's the same thing as if we were to talk about, for example, using the printer, right? If you purchased it as of June, right, and you decided to use it in the very beginning of the month, right? You could say that is more than using 50% of the month. So therefore, you need to depreciate it because you've used it for that month. You can't say, oh, I'm just going to depreciate it the next month, even though I used at least 75% of the time of the month. So think of it as that way. That same idea is going to apply here. But let's say I purchased the asset and I started using it as of June 25th. Now, June 25th and all the way to the end of the month is only 5 days. Now, can you say that you actually used it enough? No, that's less than 50% of the time. So in that case, you could easily bypass that and say, well, I'll use it starting as of July. Okay, so that's like one of the rules that you need to know, that because this is very important, especially when we dive into partial years, when we're because usually depreciation, depending on how your company is, you can depreciate it every month, or you can choose to depreciate at the end of the year. Okay, and if you end up depreciating at the end of the year, right, when we purchase our assets, we treat them like actual they actually have a life. So the day that they're born, right, we treat them like children, right? You would treat your asset exactly how you have a baby, right? If a baby is born in November, you could say that. Can you say it's 1 year old already when you reach the end of December? No, you can only say it is 2 months old. Same thing that applies here. So that's why it's very, very important to know the exact date that you place it into service. Because if we're going to be treating our assets, right, as if they have a birth date, right, then that's how you can determine the estimated useful life. So just because the year that you're depreciating it on is going to be year one, that doesn't mean it's 1 year old. It could be 6 months old. It could be 8 months old. It just depends on when you place into service. Okay? And that's the most contributing factor here. And you definitely need to be aware of when you place it into service. Okay? So again, go ahead.
Say I'm working out a problem, and instead of a service date, it gives me a purchase date. Would I go by that?
Now, there's also many rules and things when it goes to that. Now, if it's a computer, right? How long does it take you to set up?
Maybe 20 minutes these days.
Exactly, right? All you need to do is plug into a wall and hit enter. Is there anything that you need to do when it comes to setting it up for service?
You got to connect your internet service. You got to, if you have any type of accounts, you have to connect those to it.
Oh, absolutely. But that's going to be more of a software, not a hardware issue, right?
Oh, okay, right.
Mm-hmm. So the only thing that you're going to do is, and you should be rule of thumb too, is the day that you purchase it, you should check to see if the asset works, right? You don't want to buy a computer and wait 6 months later to finally turn it on, because then you can't return it. You know what I mean? There's a lot of contributing factors, especially if you find out 6 months later, oh, the monitor doesn't even work. There's a big black line in the middle of my monitor. Well, then, you just wasted however much that you spent that monitor for, because you can't return it. So general rule of thumb is, if a purchase date should be a guideline of basically the same idea, that could be technically the day that you place into service. Okay.
I just remember seeing a problem, and I remember a purchase date, but not a service date. I can't remember what it was on, but that's why I asked.
Yes, but general rule of thumb is, especially when you're dealing with electronics, definitely you'll want to check to see if it works. So you're gonna have to turn it on eventually within that same day or other days later, a couple days later. You never want to wait till 3 months later, and then you turn it on, because that the idea of what if it's a defective item. So usually general purchase date would technically be a part of placing it to service, because you got to set up your computer. So technically you are getting it ready for service. If you have to set up your computer, make sure that the printer is connected, make sure that it has all the accounts that are updated, you're technically getting it ready for service. Okay. Now, of course, most things that you just need to plug into a wall for, and it's like just maybe 10-second startup or setup, usually the purchase date would be necessary. Now, we will take an example and take a look at our fictitious business where we may have purchased the item, but it's not yet ready for service because there's a few installations that we need to take a look at. So it's technically not ready for service. Just because we turned it on, it's not ready to produce anything yet. That is where, when you have those extra factors, you need to consider that that's going to be as part of when you're placing it into service. Okay, so once again, it'll be very blatantly clear exactly on when you purchase it, but usually the purchase date is actually going to be the date that you place into service, unless it needs any extra costs that are involved to get it ready for service. Okay, so once again, this is very useful, especially when we're looking at when we actually depreciate it, whether it's every month or even at the end of the year. We're going to take a look at partial years as we go through the rest of the PowerPoint. Okay. Last but not least is going to be the different types of depreciation method. So as we go ahead and take a look at this, we're only going to be looking at three primary uses of depreciation. Okay, there's a lot out there, even beyond than what you see here. As we go more advanced level of accounting, there's again a lot more. There's weighted years, sum of the years. There's combination, or in this case, it's group. There's also hybrid. All right. There's different types of methods that do exist out there, but for this class, I want to only show you three of them, okay? And two of them are going to be primarily what the IRS would technically tell you to do. Most cases, or most often, especially if you're a major or a bigger company, it's only better to use the straight line and the double declining, because technically that is what's widely used amongst corporations. Okay. Now, again, we're not talking about corporations. We're talking about as a sole proprietor. So as a sole proprietor, I'm going to teach you three. So activity-based, straight line, and we're going to talk about accelerated, or also known as double declining. Okay. Now, again, today we're only going to be looking at one of the depreciation methods. So today we're going to be taking a look at units of production. Okay. So again, we're only learning three out of the listed amount here, because these are the common ones that you will see typically how business depreciate their assets. Okay. So any questions before we move on forth?
So for class, we're only using the three that are underlined?
We're only learning three. Okay. Units of production, straight line, and double declining. Okay. Now, again, the IRS prefers you to use straight line or to use double declining, because as we go through and learn about these two, you'll understand why. Okay. But for now, we're going to be learning the first one, which is units of production, or also known as activity-based depreciation. Okay. Any other questions? All right, so let's take a look at our first one. Okay. Activity-based, or also known as units of production. So again, whether you're going to a major company or a smaller company, these are going to be interchangeable, right? Under corporation, you're going to learn it as activity-based. Under smaller companies, you can also learn it as units of production. Okay? So these are the formulas that are going to be dealing with the units of production. Okay? We're going to be determining a couple factors. Okay? First one that we're going to be looking at is going to be the depreciation basis, right? And that's going to be your total cost of the asset minus the salvage value. Okay? And we'll take a look at every single one and we'll go through each one specifically. Okay? So once again, we're going to be determining the depreciation basis. After that, we need to determine the per unit rate. Or in this case, it's per unit rate, which is going to determine basically it's going to take your depreciation basis and you're going to divide it amongst the total amount of units that the machine can produce or whatever it is that it can produce. So that's going to give us a per unit rate. Second thing that we're going to do is we're going to determine the depreciation expense. Now in this case, the depreciation expense is going to be calculated as the number of units produced that year times the rate, the per unit rate. Okay? And then after that, we have to determine what the accumulated depreciation is. So the accumulated depreciation is going to be your previous year's accumulated depreciation plus your current year's depreciation expense. Okay? And then book value. Book value is going to be very important because as you depreciate your asset, okay, your book value is going to basically determine what value should it hold after you've used the machine enough. Okay? So as we calculate our depreciation, our book value will either equal the residual value or it's going to have to equal to 0, right? Depending on whether we establish a salvage value or not. Now, of course, this is where the matching principle comes into play because your book value can only be your asset cost, right? You have $10,000 that you purchased the asset for. Therefore, you only have $10,000 worth that you can depreciate. You can't go beyond that. So that's what book value does. It basically determines what the value is after using it for however many times that you've used it for that year. Okay? So let's go ahead and dive into the first example here. So the first example here is to record the depreciation for the first year, okay? And here it says that there were 2,100 units produced that year. So here we purchased a machine, okay? Under that machine, we purchased it for a total cost of $15,000. Okay? And we determined that the salvage value for it should be $2,500, right? Its useful life should be 5 years, and its estimated number of units that it can produce is 10,000 units. All right? And then the date that we place into service is going to be January 1st, okay? So in this case, my assumption here is that I'm depreciating it at the end of the year, which is December 31st, okay? So let's go ahead and take a look at this. How do we determine the depreciation basis? Okay? So the depreciation basis, okay? So in this case, the formula for the depreciation basis is going to be your total cost of asset minus your salvage value. So what is my total amount of asset and what is my salvage value?
So we bought 2,100 at 15,000?
No. Okay, so we bought a machine. The machine produces the items.
Oh, okay. So that has nothing to do with. Okay, I'm sorry.
No worries. Just clarification.
Okay.
So we bought a machine. The machine can produce.
It would be 12,500.
Correct, right? The asset cost was $15,000. The salvage value is $2,500. So the depreciation basis for this one is going to be whatever 15,000 minus the 2,500, which in this case is 12,500. Okay? So now we're going to determine what the per unit rate is. So in this case, it's going to be my depreciation basis divided by the total number of units that it can produce. So what are my numbers here going to be?
So are we taking
500 divided by the production life is 12 years?
Where did you get 12 years?
5 years, sorry.
Okay. Now, does it say estimated useful life?
No.
No.
so we'll take the 12,000 divided by the units produced, so it'll be 12,000 divided by the 2,100.
Now, that's how much we produced that year.
Oh, okay.
It
So-
would be
10,000
divided
times 5
10,000.
years.
Yeah, so it would be, let's see, $1.25.
Yes, in this case, so it's going to be the 12,500, right? Divided by the total number that it can produce. So in this case, the total amount that I can produce is 10,000 units. So if you did your calculation, it is $1.25. So that's my per unit rate. So let's take a look at this formula. Why did I use this instead of that? Okay, so we already determined what the depreciation basis is. Now the question is that we want to find the total number of units that that machine can produce. In this case, it can produce 10,000 units. That's the total amount, okay? That means we're spreading each cost, or the total cost, right? Or my depreciation basis. We're spreading it across by every unit that it can produce, which is 10,000 units. So in this case, it's going to cost me $1.25 for every unit I produce. So now, how do I determine the depreciation expense?
Take your units produced times the 125.
Okay, and what is the number of that I produced? That's how much I can produce overall.
Oh, I get it. Okay. So, yeah, okay, now, so it'll be the 2,100 times the 125, 2,625.
Okay, so here the formula is number of units produced that year. So that,
year one.
so year one, I've already recognized that I've already produced a total of 2,100 items. So here, let's look at the formula once again. Number of units produced that year. Okay, so what you're gonna notice is, okay, now things are starting to make sense because what I'm doing here is I'm taking my asset cost, right? I'm distributing by the number of my capacity. So I can only make a total of 10,000 units. So I'm going to go ahead and determine how much it will cost me to produce one of those items. So therefore, I got $1.25. Now, if someone told me that at the end of the year, I end up making a total of 2,100 units, my depreciation expense is going to be for that year because I've already produced the 2,100. You're going to take the 2,100, you're going to multiply it by the 125 to get the 2,625. So in this case, we're looking at two things. We're looking at the factor here that in grand total, I need to make a whole total of 10,000 units over a span of 5 years. In this case, I only produced 2,100 for this year. So that's how I determine the depreciation expense for year one. Okay. All right. Is everyone okay with this?
Yeah, if it's a unit, the number's going to be zero, but if you had it for a couple of years, then you would have a number plus the current year's depreciation. Kind of easy.
Okay. Yes. We'll take more examples of this again and again. So once again, here, you're talking about the accumulated depreciation. Did we have anything to begin with in the very beginning?
No.
No. So your assumption is usually your first year, your accumulated depreciation is going to be whatever your depreciation expense was. Because in this case, what was my previous accumulated depreciation? You didn't depreciate any time before that. So you start with 0 plus my current depreciation expense should give you $26.25. Now the last thing that we got to determine is my book value. Now what is going to be my book value? So here I have my cost of the asset minus my accumulated depreciation.
Would it be 12,375?
Good. 12,375. Right? Because we're not looking at the depreciation basis. We're looking at how much the asset cost me. Right? And because I determined what my depreciation expense for that year, because I used that machine, it came up to me to produce 2,100 units. Therefore, I need to lower the value of my actual asset. It's going to reflect as 375. Okay? Because that's how much I depreciated it for. That's how much I used that machine for. Okay? So in this case, when we're looking at activity-based or units of production, it's going to be based off of the capacity that a machine, or in this case, this machine can only produce so much, right? A good example would be a truck, right? If we can determine how many miles a truck can drive, right? Therefore, let's say this year I drove 5,000 miles. So therefore, you're going to calculate it based off of its capacity. How far can this car drive me? If it can only drive me 100,000 miles, then that's how much I can only depreciate it for. So in this case, right, it's just an example. We're going to move on and look at other examples after this, okay? So any questions in regards to understanding the units of production? Okay, let's go ahead and try for the second year then. So second year, let's say I decided that second year I determined that I drove a total of 2,000, I produced a total of 2,000 units. All right, so start from the very beginning, okay? What's going to be my depreciation basis?
12,500.
12,500. Let's go back. 12,500. Okay. What else can I determine? The next one is, what's my per unit rate?
Yeah, you can do that too. And it's 125.
Yes, because it's going to be my depreciation basis divided by my total number of units produced. So in this case, it's still 10,000, right? That's my capacity. That's how many units I can produce out of this machine. So in this case, my rate is still going to stay the same. However, what is going to be my depreciation expense this time?
going to lower to 2,500.
2,500. Okay, so there you go. So once again, right, we determined that the depreciation basis is going to stay the same. The rate is going to also be the same. The only difference here is going to be my depreciation expense, because this year, I produced 100 units less than the previous year. So because I'm on a per unit rate, right, if it's going to cost me $1.25 for every unit that I produce, in this case, it's going to be 100 items less. It's going to be 2,000 times the 125, which should give me 2,500. And once again, I got to solve for my accumulated depreciation, which is going to be my previous year's accumulated depreciation. So I had 2625, right? Plus my current year's depreciation expense, which in this case is going to be 2,500. So therefore, my accumulated depreciation for year 2 is going to be the 5,125. Okay? So therefore, my book value, right, is going to be $15,000 minus my 5,125 to bring me a total book value of 9,875. So as we keep using our product or our machine, our fixed asset, we can see that the more we keep using it, the less value that this machine will hold. And that's true, right? You buy a laptop for the first time, you use a lot of it the first year, you can expect that if you try to sell it or return it, it's not going to hold its value because of how much you used it. Now, of course, if you're selling your items on another platform, you kind of have to lie saying, oh, I barely used it. Right? But no one knows that. But other than that, this is the concept and the idea. It fits the same way too. The more I use my asset, the more it will lose its value over time. Okay? So that was just looking at year 2. Now, what about year 3, year 4, and year 5? So once again, if you want to spend the time to do that, you can, but it's pretty straightforward. Okay? Now, here's something that you're going to notice. Every year, the number of units that you produce is going to change, obviously, because every year you don't know how many numbers you're going to produce. Now, what you're going to notice is that if you add up the total numbers here, it should equal more or less 10,000 units because you have a capacity. All right? What you're going to notice here is that your depreciation basis, once you solve for 1, right, it's all going to be the same exact for every single year. Same thing with the rate, because your depreciation basis is going to always be the same. Your total number of units is going to always be the same. So in this case, once you solve for 1, you don't need to spend the time to have to recalculate these 2 columns anymore. You already solved it by solving the first one. So the automatic assumption is you can automatically determine your depreciation basis and your depreciation or per unit rate instantly. Okay? The only difference now is that because of the number of units produced that year, you're going to obviously have a different expense every year. Okay? So here I've already done the work for you. So this is just plugging in the numbers. And what you're going to notice is that every single time you calculate your accumulated depreciation, here is one thing that you need to know. At the end of the 5th year, okay, your depreciation basis is going to be your accumulated depreciation at the end of the 5th year. These numbers must match because at the end of the day, right, if it holds a value of 2,500, you can't go beyond it, and you can go under it, but you can't go beyond it. And what you're going to notice here is that your book value should be equal to your salvage value. So here, we're ending with the 2,500, which is what we said at the end of its useful life. It should hold a value of 2,500. And here it is. Okay? Here it is. Okay? Any questions in regards to this? Here you have a lot of things where you can match up to ensure the accuracy of your accounting. Any questions?
I'm not sure. I'm still kind of okay. So yeah, no, I think I get it because you let me see real quick here. Let me go back up. Yeah, because you determine the useful life is 5 years, so you wouldn't go over that for as far as depreciating it. So yeah, no, this is pretty cut and dry.
Okay. Anybody else? Now, once again, this may not make sense if it's confusing to you now. It will make more sense as we progress and continue doing more and more problems. Because in this case, when we're dealing with units of production, okay, we have a capacity, okay, and we also have a salvage value. All right. Now let's hold on to that idea because I'm going to show you another example. Now let's say what happens if I decided that year 5, I end up producing 2,200 items. Okay? So let's go ahead and solve for this. So what's my depreciation basis and per unit rate?
$125.
Okay, 125. Okay, so what's my depreciation expense going to be?
Negative 250.
125 times 2,200. How did you get negative number from
No,
there?
no, no. So I came up with yeah, 2750. My fault. And now I was trying to. Well, now do we depreciate that, or do we just keep adding that to the book value?
Well, I mean, your book value should just fall below. It shouldn't get. What did you got? Negative 2,250.
No, no, yeah. I was trying to like, because I see the 12 something, and I know the original cost
Uh-huh.
was 15.
Mm-hmm.
So we can't write the. Yeah, never mind. I'm overthinking it.
Well, you still got a positive number.
Yeah.
Okay. Now, this what would happen, right? If you went over capacity, because you can, right? A lot of times, oftentimes, when you do produce your machine, right, it can go beyond capacity, right? That's just because it can, right? Maybe you kept your machine very well oiled, or you maintained it very well, so it actually produced an additional 100 units. Now, in this case, when I've calculated it, right, now here's a few things. My depreciation basis is definitely increased, and my value of my book value has also decreased to 2,250, right? So that's what my book value holds as of the 5th year. Now, here's a rule that you need to know. You cannot go beyond capacity, all right? Because what happens is that, let's say you do and you do end up having that capacity, right? You may encounter a lot of defective items, usually because at that point, the machine's already 5 years old. It's already produced so much. You never know. Your chances of having a defective item is a lot higher, okay? Because the machine is older. Its gears are not up to par as it was the day that you purchased it, okay? So in this case, you cannot ever go beyond the capacity. If it says it's 10,000 items, you can only strictly stay at 10,000 items. Second thing is that here's one rule here. Your book value can never fall below salvage value. Okay? All right? Because that's what you determined it. Now, of course, you can obviously inspect your items, and if it does end up being this way, that all of those extra 100 items are still okay, none of them were defected, you could still keep that items, but however, when you're writing it off as depreciation, you're going to have to write it off as the capacity amount, and your book value must always be equal to your salvage value. So at that point, you don't recognize the expense at all. You just keep those extra items, but however, in your books, this must hold true. You must stay at salvage value unless you decide to revalue your asset. Then yes, which again, that's more advanced level of accounting. Okay? Like if you add maintenance to it, yes, you can extend its useful life. And you can also increase the value of it if you add any of those things. But once again, that is definitely something you will take a look into the future if you do pursue accounting. But for now, rules are rules, okay? You cannot fall below salvage value. Okay? All right? And you cannot go beyond the capacity. So in this case, we would have to determine what the capacity it is and then determine how many units I need to produce in order to meet my requirement amount. Okay? So, go ahead.
It's just a general question.
Mm-hmm.
So I put this unit into production for the 5 years.
Mm-hmm.
It produces its 10,000. So at that point, I can no longer depreciate it, but can I still keep it in service?
Yeah, but you would just have to reevaluate it. So then, or you may have to do some maintenance routines on it because it's already reached its capacity. So again, this is advanced level accounting. Yes, so once it's reached its end of capacity, if you do maintenance, if you replace certain parts of the machine,
refurbish.
Exactly. Therefore, okay, I extended the life of it. I extended the use of it. So yes, again, that's all going to be considered advanced level accounting. So yes, you can add fixtures, you can replace parts, so it can go beyond its capacity and you can revalue it because obviously maintenance is going to cost you money, right? If you're adding new stuff, then you're adding more to the cost of the asset. And yes.
And if you were to do that, then you would start back over again at the beginning with your new value and everything?
Correct.
Okay.
Yes. Yes. So yes, you can keep a machine because I know, right? We talk about, or, the idea of those old cars, right? As long as you replace the motor, right? You essentially have a brand new car. But it's got an old body frame, whatever you want to call it, right? Yes, you can. And those kind of cars, right now, they're on the market for a bunch. They're very expensive right now because, yes, the machine, the motors, they've been updated, right? You refurbish it. You replace the parts. Therefore, you're adding and adding and adding more to the actual cost of the original car itself. You're making it function. It's working now. So yes, you can add and revalue your asset at any given time. Okay? You don't have to wait till the end of its life to do it. You could do it at any given time, but you want to make sure when you're following the rules of depreciation, you should try to seek it all the way out and then do your maintenance and then make fixtures, replacements, whatever it is, and then basically revalue the cost of the asset and basically start your process all over again if you plan on doing that. But for most cases, right, especially machinery, if it's gonna cost you a bunch of money to fix the machine when you can just go ahead and buy yourself a new one easily, right? So a lot of example, right? Fixing up an old car. It will take you maybe $20,000 just to buy a brand new motor for your old car to work. So why would you spend $20,000 to fix up an old car when you could take that $20,000 and dump it in a brand new car that can last you for newer, obviously, right? It's a brand new car. You can go longer. You can go, the mileage is at 0. The life of it's longer, et cetera, et cetera. So again, most companies, right? They actually, I mean, it's common that they try to attempt to fix the issue because it still can run. But sometimes those things are more costly than it is, especially with technology, right? Once again, we visit the idea where your assets, right? They can be outdated. Technology becomes outdated. They may not even produce that item anymore. So it's going to cost you way more to buy that replacement part for an inexisting product. So you're going to be spending a lot more money than you would just normally buy a brand new machine. So that's where the cost benefit is going to come into play, right? Would it benefit you to try to restore this machine or for the price that it's going to cost, or would it just benefit you to just buy a brand new machine? So again, if it's a small fix, then you can go ahead and do it. But if it's a huge costly project, you're better off just buying a brand new machine. Okay, so yes, you can revalue your assets, and yes, you can push it beyond capacity. All right, any questions here?
No.
Okay. So now we're going to talk about how we actually journalize it when we reach our total, at the end. What do we do when we recognize depreciation? Okay. As I've mentioned before, it is going to be considered an expense because we used the item, right? Expense is going to be considered something that you used, something that you spent, something that you got rid of, or something that you need to encounter in order to operate your business. In this case, we need to find a way to recognize that we use our asset. So in this case, you will be looking at depreciation expense. Okay. Now, the second thing you're going to be looking at is going to be a contra account. This contra account is going to be called the accumulated depreciation. Okay. Now, this contra account, once again, is going to be the contra account to the actual fixed asset because what do we know? GAAP says that you can't just write your cost right off of the actual asset. That's illegal because you cannot recognize a invisible loss, right? You can't recognize that you lost value because you decided to use your product. Okay? So it's kind of confusing because in reality, it loses its value anyways. But that's why we have to create a contra account so we can reflect the book value accordingly. Okay, so this is the two things that we're going to be looking at. Depreciation expense because we need to, incur the expense it took for using those items. And the second one is going to be the contra account, which is called the accumulated depreciation for that specific asset. And we're going to write it off for whatever depreciation expense was for that year. Okay. So once again, if it's the first year of depreciation, that's what's going to be. It's going to be for the 26-25 because that's what we calculated in the first year. Okay. Now, for every year that you do your journal, it's going to reflect on your calculations that you created in the table. So in this case, for the second year of depreciation, I only produced 2,000 units. So therefore, my depreciation expense for that year is going to be for the 2,500. So therefore, here, my journal is going to reflect the same. Depreciation expense and accumulated depreciation for 2,500. Okay? Now, question here is saying, well, in the table, it says the accumulated depreciation is 5,126. This number should match your ledger account for the accumulated depreciation. Okay? Because once again, you're adding the first year plus the second year. Okay? And every time we journalize it, right, we need to update our ledger. So in this case, this is the second year. So therefore, this $5,000 amount is going to be what's going to be on your ledger account, not your journal. Your journal's only going to reflect what happened at that moment. It's not going to give you an account balance. So in this case, the one thing I'm recognizing that year is that I'm creating a depreciation expense for the $2,500 for the second year. Okay? Any questions so far?
No.
Okay. Now, this is where we're actually going to take into consideration, well, what happens if I bought the asset in the end of the year? Okay, so in this case, we're going to be dealing with partial years. So here's the example here that on October 1st, okay, we decided to purchase a machine for a total of $10,000. It has a useful life of 5 years and a capacity of producing 25,000 units, okay? It also has a salvage value of 2,500, okay, at the end of its life, okay? If the machine was put into service as of October 18, okay, record this depreciation for the end of the year, assuming that the depreciation is done at the end of the year, okay? So here we have the 5 components, right? We have our asset cost, we have the salvage value, we have the number of units that it can produce, or the estimated useful life. We have both in this case. And then we also have the date it's placed in service, and of course, we're working on units of production. So in this case, if you guys remember, the day that we place it into service is very important. So in this case, if I place it into service as of October 18, when do I actually start depreciating it?
The next month.
The next month, because you haven't used more than 50% of the machine yet. So in this case, is it fair to say that you can depreciate it for the month of October? You barely used it. Okay? So in this case, we're only going to depreciate it for the month of November and the month of December. Okay? So therefore, there's only 2 months out of the year that we're actually depreciating it. So therefore, let's go ahead and determine this. So in this case, right, this machine ended up producing a total of 250 units, okay, for the first year. Now let's go ahead and determine what the depreciation basis is, the per unit rate, and so on and so forth. So what's my depreciation basis?
$7,500.
3,500. Depreciation basis is going to be 10,000.
7,500, I said.
Okay, 7,500. I thought I said 35. Okay, 7,500. Perfect. All right. What's my per unit rate going to be?
Is it going to be 2.5?
2.5. I believe to go over 2 more decimals.
3.
0.3. Good. Okay. And then lastly, what is my depreciation expense going to be?
$75.
Okay. So again, right, plugging in those numbers, right? I determined that the depreciation basis is going to be my 10,000 minus my salvage value, which should give me 7,500. Now the per unit rate is going to be my 7,500 divided by my total number of units I can produce, which in this case is 25,000. So bringing my total rate to be 30 cents per unit. So in this case, because I only produced 250, I get a total of 75. Now in this case, how old is my asset?
Only a couple months.
Is it 1 or is it 2 months?
Oh, it would be 2.
It's only 2 months old. And in this case, time is not a factor. This asset can go on for beyond its useful life, right? Just because I say it can last you 5 years, right? The most important thing that you need to know is that it's based off of its capacity. So by year 5, let's say, right? If I'm only at 21,000 units, I can still keep going because it doesn't matter how long I have the asset for. It matters on how many units I can produce. Hence, that's exactly why it's called activity-based depreciation, because we don't care about how long you have the asset for. We care about how much it can produce. And in this case, is my asset 1 year old? No, it's only 2 months old. Because we have to treat it the day that we place into service is the day that the asset was born. Okay? So in this case, my asset is only 2 months old. And right, it only produced 250 units. So as beyond its capacity, right, the age of the asset does not matter. What matters is the capacity. Okay? So in this case, is my asset time sensitive? Do we care how old my asset is?
No.
No. Okay? Now, I'm telling you this now because when we dive into double declining or even straight line, the age matters. Okay? Age matters. In this case, for this example here, age does not matter at all. Right? Okay. So once again, we do the same thing when we're talking about journalizing the assumption here. So every year, your journal for depreciation expense should be different every year because it depends on how many units that you produce that year. So that's going to be one of the contributing factors of determining your depreciation expense. It will change every year. However, the journal itself, the accounts that you're using, will stay the same. It's just the number of your debits and credits will change every year. Okay. Any questions in regards to the first depreciation method? Okay. So once again, we took a look at Chapter 11 review. So here again, we looked at 5 components, right? You need the total assets cost. You need to know its estimated useful life or the number it can produce. You need a salvage value. You need to know the date that you place into service. And you also need to know what depreciation method you are using, okay? Once again, they're broken down into a few things that you need to know, such as the date that you place into service is important because you want to determine how much did you use it for that month. Okay, so it's anywhere between the first 15 days, you depreciate it that month. If it falls below the first 15 days, like anywhere from the 16th to the 30th day, then you depreciate it the next month. Okay, other things that you need to know is going to be the determining factors of the estimated useful life as well as salvage value. So under Acct, you're only limited to 5 and 7 years, no salvage value. Under management or sole proprietors, you can determine the useful life and you can also determine the salvage value itself. Once again, the general journal for depreciation is going to be depreciation expense and the accumulated depreciation. And we'll take a look at this, okay? And also make sure that you know that depreciation expense is going to be considered an adjustment entry. It only happens at the end of a given period. In most cases, it's usually at the end of the month, or it could be at the end of the year. Usually, it's most likely going to be at the end of the year. Okay? And of course, here's the formula for units of production, right? So once again, this is the sheet that I'm telling you to hold on to, right? It's very important that you kind of know the difference, because when we look into the other two depreciation methods, they're going to look similar with a slight different variation between the formulas. So it's make sure that you do know, because I don't want you to confuse the three different methods. They're very similar to each other, just different. There should be like maybe a few minor changes into the formulas. Okay? And once again, we talked about how units of production, the most important factor is that age does not play a contributing factor to this. It's based off of the capacity that the asset can produce. Okay? So very, 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 very important that you know that. It's based off of capacity. You can't go beyond it, and you can definitely go below it, but you can't go beyond it. Okay? All right. Again, no questions. So right now it is 3.
I have one quick question.
Go for it.
On the first chapter 11 review sheet,
Okay.
okay, please excuse my ignorance. I understand depreciation for fixed tangible assets. On the right side, it says amortization for intangible assets. What's that?
So that's what we're going to learn on Wednesday for chapter 11.4.
Okay, well then that's good. I didn't see that word before, and I'm like, wait a minute.
Well, I mean, you should have seen it when you were reading the chapter 11.
Well, I didn't see it in this slot in this presentation.
Oh yeah. It's because when I first did this, the PowerPoints for when I taught this last year, I did chapter 11 as a whole entire unit.
Okay.
So then the students got more confused, so I decided to split it up.
I just don't like to write notes in my notebook that aren't for the current subject. So that's why I asked you about that, because I didn't see it in any part of what we went through for the activity